Mark, good morning. What is, from your perch, the state of the global M&A market right now?
Good morning, Brian. It's a pleasure to see you. As you noted in your intro, like so much else in the economy today, deal making and the global M&A market has been severely impacted by the pandemic and the corresponding lockdown that's followed it. For the past 6 or 7 years, as all your viewers know, we've been in virtually a bull market for global M&A and deal making generally. And the first quarter of 2020 started to see a significant slowdown in global M&A and also in U.S. M&A as the economy faced headwinds, trade wars, other issues, restrictions on foreign direct investment. And then as the impact of the pandemic and the lockdown spread, M&A collapsed in April. April was the single worst month for M&A on record in the past 7 years. And not only did new transactions stall, but there's been a marked increase in litigations where buyers that have already signed up for existing deals pre-pandemic have been trying to litigate to step away from those deals that they signed up on.
All right, so we know this. The bond market in many ways has gone on fire, right? Companies are raising cash by the hundreds of billions of dollars globally, Mark. Are they trying to hoard cash because they anticipate deal making ahead, or are they trying to hoard cash because they're trying to protect themselves for down the road?
Look, Brian, great question. Right now, we're in a very anomalous situation where the capital markets are very liquid, public valuations are quite high, yet deal-making activity remains somewhat stagnant. Certainly, companies, as you well know from being on the show every day, have been hunkered down trying to raise cash to shore up their balance sheets. And as you know, companies are pulling out of the stops to raise cash. And regardless of the cost, and leaving aside certain sectors like healthcare, tech, and consumer staples, they're facing unprecedented drops in revenue. M&A is unlikely to be a solution in the very short term for those companies, even for those that are raising cash. Due to the high public market valuations, the potential large cap sellers have not yet capitulated on value to reflect the new normal that's going to be reflected in revenue, particularly as I expect you start to see second quarter earnings report. Only companies right now that are in need of rescuing, and think poorly capitalized companies, think family-backed companies, think certain sectors of the middle market, are signaling that they're willing to be acquired. At the same time, potential buyers in the large cap market can't rely on one of the traditional levers that they use to drive M&A, which is synergies. Right now, synergies can't be harvested fast enough to make up for the decrease in revenue that people are seeing, including at targets that they're looking at. So I think right now, in the immediate short term, you're unlikely to see that cash hoard that's getting raised be used to affect M&A in the large cap spaces. You will see distressed M&A. You will see some people opportunistically looking to consolidate the market, but I don't think you're going to see a wave of large cap M&A yet.
Okay, so we know that the LBO, leveraged buyout market, is basically toast right now, but I cover oil and gas. There's so many highly leveraged companies, particularly in energy, not just in energy, but particularly, and we've seen a lot of them go bust. I mean, Hertz and others. What is your advice to the CEO of a highly levered company right now? Their business is not recovering very quickly. They're just trying to hang on. What strategies can they enact to try to protect their balance sheet, Mark?
Look, great question. And by the way, on the leveraged buyout market point, starting to hear, even within the last 12 to 18 hours, rumors about bankers trying to unlock liquidity to finance the leveraged buyout market. Somewhat late breaking news, but bankers are trying to figure out ways to extend capital so that you can reignite the leveraged buyout market. Going back to your question about what can highly leveraged companies do right now, obviously what people have been very focused on, raise capital as quickly as you can and put as much capital on your balance sheet as you can, whatever the source and whatever the cost. Manage your operating expenses and really try to stem any kind of bleed. I think going beyond that, one of the things that I talk to CEOs and investors about regularly is in an environment like this, trying to use operational leverage, right? You may not have to be in a really prolific period of economic success, but if you're standing stronger than some of your competitors in the market, you may be able to use that as leverage in negotiating with either people that you have costs running out to, or even with your customers to try to recut better deals if you happen to be, even slightly stronger than some of the peers you compete with. At the same time, you could be looking at repurchasing debt in the market. If your debt's trading below par, there may be significant opportunities to delever on a price basis that's quite advantageous. You obviously need to pay attention to your debt instruments. You may have to look at restructuring your credit. And then I think what we're going to see a huge wave coming up in the fourth quarter to the first quarter as companies that are highly levered that realize they cannot grow their way out of the situation they're in because revenues are coming in and remaining lower than they were in 2019. I think you're going to see a large wave of asset and divisional sales.